All right, let's dive into Amrize's latest earnings report. This one's a real head scratcher because the headline numbers seem to tell a completely different story from how the market reacted. Let's get right into it. Okay, so get this. On February 17th, Amrize comes out and says, hey, we missed our big revenue goal for the quarter. You'd expect the stock to take a nosedive, right? Well, nope. Instead, it shot up, jumping almost 11% in a single day. So what on earth is going on here? This is exactly the kind of puzzle we love to solve. What did Wall Street see that most people missed? It's a perfect example of why you've got to look past the big, flashy headlines to find out what's really happening inside a company. So here's how we're going to break it all down. First, we'll tackle that confusing headline. Then we'll dig into what investors actually saw that got them so excited. Of course, we'll look at the not-so-great numbers too. After that, we'll explore the two very different sides of Amrize's business, check out their game plan for 2026, and then wrap it all up with the final verdict. Right, that confusing headline. You know, it's a classic case of the top-line number, the big revenue figure, not giving you the whole picture. Not even close. So it turns out, while everyone was hung up on that revenue miss, the smart money was laser-focused on something else entirely. And that was the company's incredible profitability and just how well they were managing their cash. Investors really zeroed in on three huge wins. First off, Amrize actually made more profit than expected. That's a big deal. Second, they generated a massive $1.5 billion in cash over the year. And third, they really cleaned up their balance sheet and paid down debt, which makes the whole company way more financially stable. And you know, that free cash flow number is just absolutely critical. Think of it like this. It's the pure cash profit a company has left over after paying all the bills and investing in itself. It's the money they can use for the things that shareholders really, really care about. And Amrize didn't just sit on that cash. Oh no. The CEO came out right away with a major plan to give a huge chunk of it back to investors. And that, my friends, is a move the market absolutely loves to see. First up on the list, a massive $1 billion plan to buy back their own stock. What that does is it reduces the number of shares out there, making every single remaining share that much more valuable. Then, bam, a special one-time cash dividend of 44 cents for every share you own. It's basically a direct thank you check for being an investor. And just when you thought they were done, they added another layer. On top of everything, they're starting a new, ongoing annual dividend, also at 44 cents a share. So you've got this powerful 1-2-3 punch, a buyback, a special dividend, and a new regular dividend. That's an incredibly strong signal of confidence to everybody watching. Okay, but let's be real, it wasn't all sunshine and rainbows. To get the full picture, we have to look at the numbers that sparked all that initial concern in the first place. And the big one, of course, was that revenue miss. They came in more than $100 million short of what Wall Street was expecting. And what's more, their sales were actually down just a tiny bit, 0.4%, compared to the same quarter last year. But to their credit, the company didn't beat around the bush. They were super direct about the cause. They pointed the finger at one specific area, a slowdown in their business that sells roofing materials for people's homes. And this, right here, brings us to the real heart of the story. Because Amrize isn't just one single business. You have to think of it as a tale of two very different companies just operating under the same roof. And wow, the difference between these two segments was like night and day. On one hand, you have their building materials division, the part that sells stuff for big infrastructure projects. That grew really solidly. But then you have the building envelope side, which is tied to that weak residential roofing market, and it just got hammered. Sales were down almost 12%, and a key profit number was down over 23%. Ouch. You can really see that dramatic split right here. Investors looked at this and saw incredible strength in the company's core materials business. They basically made a bet that the weakness in roofing was just a temporary blip, not a long-term problem. At the end of the day, investing is always about betting on the future, right? So let's look at how Amrize's plan for 2026 was the final piece of the puzzle that really sealed the deal for investors. Amrize laid out a super clear three-part game plan. Step 1, double down on what's working by pouring money into their strong segments. Step 2, get lean by cutting costs across the whole company. And step 3, promise to deliver much, much better results next year. And they didn't just make vague promises. They backed it up with some seriously confident numbers for 2026. They're telling the world they expect revenue to grow between 4 and 6%, and for their core profits to grow even faster, somewhere between 8 and 11%. So let's bring it all home. Let's tie this all together and figure out why the good news clearly outweigh the bad news for the market. So, when you put all the pieces of the puzzle together, you can totally see why investors were willing to look right past that one-quarter revenue miss. They rewarded Amrize for a profitable core business, for generating a ton of cash and giving it back to them, and for laying out a very strong, very confident plan for the future. In the end, this was a classic Wall Street move, betting on a company's future potential over its recent past performance. Which leaves us with one final fascinating question to think about. Will Amrize actually deliver and prove this was a smart bet, or did investors just take a very risky gamble? I guess only time will tell.